Video we're going to talk about FHA loans. That's the Federal Housing Administration. So it's a government-backed loan, and we're going to talk about what's it all about. You know, how do you go about getting one? How much do you need to put down? What are your credit score requirements? What's your debt to income ratio requirements? And to know that it's a really good kind of loan. And most people think it's actually just only strictly for first-time home buyers. That's actually not true. So we're going to go into all those all those things in this video, talk about it. First thing to discuss about FHA loans, the credit score requirements, because in any loan program, if you're a first-time home buyer, or even if you're buying a second home or an investment home, one of the major criteria that a lender is going to use to judge if they're going to give you a loan, firstly, is your credit score. And the reason that is because a credit score is just kind of like a snapshot of your history as a borrower. In other words, if we lend this person money, what's the risk that they won't pay us back? And the higher your credit score means the lower risk, or the lower the credit score means the higher risk it is that you may default or you may not pay the loan back. So high score is good, low score is bad, we know that. So, but the good news is that for many programs, say for example conventional loans, which I went over in another video, and if you're interested in that, hey, check this link out above, where I talk about conventional loans and conventional financing. If you want to find all about that, click that link. However, in this we're talking about FHA loans, but the point is, in conventional loans, you need a credit score of around 620 and above. So what about the situation where you have a credit score that's less than that? Well, that's where FHA can really come into play and be a good deal for you. And that's because FHA financing, that'll allow you to have a credit score as low as 500, even 500, up to 620, you're all good to go, with an FHA loan program. So, let's dive into that a little more deeply, because, there's a little more involved in that. So, firstly, that credit score range can then be further divided into two ranges. One is a 620 down to 580, and 580 down to 500. And the reason that we divide that is because it's then related to how much is your down payment that you're going to be required to put down to get FHA financing. And that in fact is the second major criteria of getting a loan and FHA program is your down payment. How much are you going to put down? Of a $500,000 purchase, if you've got a credit score that's in the lower range, the 500 to 580, that's going to require a 10% down payment. That's going to be $50,000. But if you have a credit score in the range 580 to 620, you only are required to put 3.5% down. That's going to be $17,500. So there's a big difference, $17,500 or $50,000. So, that's a really good deal, and part of the attraction of an FHA loan is that you can have a low credit score. And think about that. You can get a $500,000 house with just $17,500 in a down payment with a low credit score. That would be impossible in a conventional loan. You're not ever going to get approved if you've got that low credit score and try to put that little amount down. It's just not going to happen. So, just be aware that that's a really good program. It's a government-backed loan. It's the FHA loans, part of HUD. So that's a good deal. So the thing also is you can put more down, and putting more down is always a good idea because you build more equity straight away. However, generally speaking, people who are working with an FHA style program are not generally in the position, generally speaking, they want to put as little down as possible. There is, like other loan programs, you're going to have to get what's called mortgage insurance, and in the FHA they call that a mortgage insurance premium, MIP they call that, and that's actually goes for the life of the loan. So the thing about a mortgage insurance premium too with an FHA loan, it's actually going to be part of your monthly payment. So that means, if you are putting just the 3.5% down, and you have a lower credit score, you're going to have a little bit more to pay with your mortgage insurance premium. That's going to mean your monthly mortgage payment is obviously going to be increasing, because you have to add that mortgage insurance premium on top of the rest of your mortgage payment. However, in addition to that, with an FHA loan, what you need to know is that in addition to your monthly mortgage installment premium, you also have to have another one that's up front, and that's 1.75%. So let's use round numbers rather than exact figures, just to give you a general idea. Let's say you had a $500,000 home. You're purchasing a $500,000 home with an FHA loan, which you can do, and you're putting 3.5% down. Okay, so 3.5% down is around $17,500. After you put the 3.5% down, you're going to owe about $482,000. I'll just round the figures up. So now you're owed $482,000, and so that's what your loan amount is going to be for. So you now owe your lender $482,000. But with an FHA loan, what they now do is you're going to also pay a upfront mortgage insurance premium, and this is in addition to your monthly mortgage insurance premium. So there's two different mortgage insurance premiums you have to pay with an FHA loan. One's up front and one's part of the monthly. And the way they calculate the up front, let's go back to our example. You got a $500,000 house. You put 3.5% down, which takes the loan amount now down to $482,000. So now you owe $482,000. The upfront mortgage premium is 1.75%. As you multiply the $482,000, the balance of what you owe, by 1.0175%. So what that means is the $482,000 now becomes $490,000. So now you owe $490,000. That's the amount that you owe. You're going to be paying back in your mortgage, and that extra $8,000, the difference between the $482,000 and the $490,000, that's your upfront mortgage premium that you're going to be required to pay in your mortgage. And in addition to that, now you're paying that extra $8,000 up front. You're also going to be paying for the life of the loan a monthly mortgage insurance premium every single month of your FHA loan. If you're putting say 3.5% down, you're going to be paying that monthly mortgage insurance premium for the whole life of the loan, whatever it is, 20 years, 30 years, whatever it is. However, if you put 10% down or more, then after 11 years, you can have that monthly mortgage insurance premium dropped off the loan. So you won't need to pay it after 11 years. So the insurance, monthly mortgage insurance premium can drop off if you put over 10% or plus down in your down payment. In the FHA program, you have more leniency in terms of your debt to income ratio. So that's a good deal. In a conventional loan, which I talked about in another video, we made a note that in a conventional loan, your debt to income ratio can only be as high as 43%. So once your debts go over 43% of your monthly income, you're no longer going to qualify for a conventional loan. However, in the FHA program, you can get up to 57% of your debts. So that's a good deal. That means you have a little more flexibility in that loan program. If you've got more debts, you maybe got student loan, car loans, and credit cards, and every month, all those debt payments are coming, around 50% or, under 57%. You're still good to go to get an FHA loan. So that's really good news about that. But however, there's one thing where FHA is a little more restrictive than say a conventional loan program, and that is in the next area is that an FHA program can only be used for you as your primary residence. In other words, you have to be owner occupied. Whereas a conventional loan, you can get a conventional loan for an investment property. but you cannot do that with an FHA program. So with an FHA loan, it doesn't mean, however, after you've been living in a property for a year or more, that you could rent the property out, for example. So people do that. That's something you can do. But technically, it's an FHA loan, must be for your primary residence and be owner-occupied. Okay, so then the next requirements that come in an FHA program are going to be the other similar things in other loan programs. Are going to be things like proof of employment and your income levels. And once again, they're going to be requiring you to have, say, 2 years of work history, of employment. There's not really, again, a limit of a minimum amount of money that you should be making or a maximum. It's more related to however much money you're making, what is your debt that's related to your income in terms of a month-by-month basis, getting back to the debt-to-income ratio. Then also, of course, the other similar requirement is some proof of funds in terms of your assets. How much money do you have in your bank account, or other assets. Maybe you have some another property, or maybe you have an IRA or a 401k or something of that nature, because the lender's gonna need to see that you have enough cash on hand to handle the down payment and to handle the closing costs. And like we mentioned in other videos, part of the closing costs are what they call prepaid costs. Usually what they do is a lender, let's say your monthly mortgage payment with all your mortgage premiums and everything else comes to $2,000 a month. Well, before they give you the loan, they want to see that in addition to, let's say you're putting 10% down on a $500,000 property, that's $50,000. They want to see that you have that $50,000 in the bank, or let's go 3.5%. That's going to be $17,500. They want to see you have the $17,500 in your bank account. They also want to see, because you got a $2,000 a month loan, they want to see that you've got $4,000 in the bank in addition to the $17,500. That's going to be that they're going to impound. So that's going to be used to pay your first 2 months of your mortgage payment, so that for sure you've got 2 months already prepaid in the bank, ready to go. And in addition, you're going to have some other closing costs as well. So, before you're going to get approved for a loan, the lender is going to need to see proof of that you have funds and capital that you're able to finance the loan, all those different things. And so, with that in mind, that's the basic aspects of an FHA loan. If you have any questions, hey, do leave me a comment. I really enjoy that. So I like it when you leave us a message. Do leave one below, and if you do leave a message, I'll definitely try to answer it. I do enjoy, at least I'll try to answer it, in the comments. But also, maybe I'll make a video for you too. If it's an interesting question, it might be, a good question to make a video. And also, if you found anything in this video useful or helpful, hey, do me a favor, hit that like button, hit the subscribe button. We can get the message out. I'm doing this, a lot of this is for educational purposes, to help first-time home buyers, figure out what's it all about, what do I do, where do I go, how do I go about it. So it's for your benefit. I'm not really making any money out of doing this, so I hope you get some benefit. So do me a favor, hit the like button, subscribe, stay tuned for more videos, and I'll see you in the next one.